Hello, welcome to Accounting 615, Lesson 16, Performance Measurement. The purpose of this module is to talk about techniques companies use to measure and evaluate performance. Let's go back to basics and examine the decision-making of companies. In general, a company can operate using a military form of operation where the decision-making is centralized, or a more democratic form where the decision-making is decentralized. A lot of countries in Europe, especially Eastern Europe, prefer the centralized form of decision-making. However, most companies in the US operate in the decentralized mode. Let's focus on the decentralized authority structure. When a company adopts the decentralized form of decision-making, each division is given authority to make decisions. This is an example of a decentralized structure in front of you. Divisions A, B, C, D in this example are divisions of a company which have the authority and responsibility to make decisions. If decision-making is delegated to divisions like you see in front of you, the divisions in accounting are called responsibility centers. So in accounting, the divisions are called, one more time, responsibility centers. If a company uses centralized decision-making, the CEO has to take the blame for any failure. If decision-making is decentralized, then the company has to set up a reward and penalty system to ensure that the behavior of managers is in the best interests of the firm. In general, if a firm is decentralized, the accounting system is set up to reward good behavior and penalize bad behavior. This is referred to as responsibility accounting. Let me repeat that. If a firm is decentralized, the accounting system is set up to reward good behavior and penalize bad behavior. This is referred to as responsibility accounting. So, what is responsibility accounting? Responsibility accounting is the process of recognizing subunits within the organization, assigning responsibilities to managers of those subunits, then evaluating the performance of those managers. So responsibility accounting has three elements. You recognize subunits, assign responsibilities to managers of those subunits, and then evaluate the performance of those managers. In responsibility accounting, the managers are in charge of divisions, except we don't use the word divisions anymore. We use the word responsibility center to describe those divisions. There are three types of responsibility centers. They are cost center, profit center, and investment center. How is it categorized? Categorization is based on the level of responsibility given to a manager. Cost centers have the lowest level of responsibility. Profit centers have a higher level of responsibility, and investment centers have the highest level of authority or responsibility. Look at the chart in front of you. Managers in charge of cost centers only have the responsibility of managing costs. Their performance is measured on the level of costs. Costs have to be kept to a minimum. They are rewarded if they keep costs within budgeted levels. If a manager is in charge of a profit center, the manager is responsible for both sales and costs. The performance measure is profit. The higher the profit, the more managers are rewarded for their performance, and vice versa. If a division is considered an investment center, then managers are responsible for sales, for costs, and the investments they make. When I say investment, I mean the assets they buy. They are evaluated on a measure called return on investment, which goes by the acronym ROI. If ROI increases, managers are rewarded, and vice versa. ROI is a measure you have seen before in a prior module. Let's do an exercise together. Have a look at the problem coming up. The problem relates to Maple Way Golf Course. And I want you to read the problem and state if the manager in each case should be treated as in charge of a cost center, a profit center, or investment center for the purpose of performance evaluation. So you have Eric Olson, Jennifer Jones, Edwin Moses, Mabel Smith, Wanda Itami, and Jake Reese. Take your time, think about it, and for each, tell me whether you think it should be a cost center, profit center, or investment center. If you want, stop this recording now, do the problem, and then restart when you're done. Are you done? Here are the answers. Eric Olson is the general manager of the golf course. He probably has not been given responsibility to expand the facilities. So I don't think he can buy more land and increase the size of the golf course. Therefore, Eric would be in charge of sales, and he'd be in charge of costs, but not, I repeat, not investment. So it would be a profit center. Jennifer Jones is responsible for maintaining the golf course. She has no direct control over revenue. So if revenue declined, could you blame her? I don't think so. So her position could be considered as a cost center. Edwin Moses is the manager of the restaurant. So he's responsible for revenues and costs. If revenue declined, you can blame him. If costs increase, you can blame him. So his position would be considered a profit center. Mabel Smith is the head golf pro and responsible for the golf shop and golf lessons. She should be treated as a profit center because she controls both revenues and costs. Wanda Itami is manager of the swimming pool and family recreational activities. Other than swimming lessons, most of these activities are not really revenue generating, so Wanda could be considered to be in charge of a cost center. Jake Reeves is tricky. Jake Reeves manages golf carts. Golfers are charged extra for the golf carts. So you could call it a profit center since he's responsible for revenue and costs. However, if Jake has the authority to buy golf carts, and if he's responsible for maintaining golf carts and has the authority to buy more, you could treat Jake as a investment center. So that could be right too. Now, let's focus on investment centers. In investment centers, the manager, as I said before, is evaluated on performance using a ratio called return on investment, ROI. The formula is in front of you. It's earnings before interest and tax. When I say earnings, I'm talking about profit. So it could be profit before interest and tax. Earnings and profit are used synonymously. So earnings or profit before interest and tax divided by average assets, which is also called investment. The term average assets and investment are also used in accounting textbooks, used synonymously. Why is ROI important? ROI is a very popular measure of performance. It has intuitive appeal since ROI can be compared to what is referred to as cost of capital. Cost of capital is the interest cost of borrowing, which we'll discuss later. If ROI is greater than the cost of capital, then it sends a positive signal to investors. So the stock price goes up, which means the value of the firm increases. If ROI is less than the cost of capital, it sends a negative signal to investors, and the stock price generally declines, which means the value of the firm decreases. Do you buy there'll be an incentive to increase ROI to look good? So that brings me to the question, how can managers cheat? Okay, the word cheat may not be appropriate because it's too strong. So let me rephrase. How can managers manipulate? I think that's a better word. Manipulate to increase ROI. How can ROI be manipulated? Here's the formula again. ROI is profit or earnings before interest and tax, the same thing, it's the same, over average assets. Now let's go back to an accounting equation we did way back. Profit equals revenue minus expenses. Let's focus on the numerator of the ratio, of the ROI ratio. If you increase profit, you increase ROI. Managers increase profit by trying to cut back expenses. The most popular ways are managers cut back on research and development expenses. They could cut back on expenditure on employee training. If they do that, in the short term, profit will increase, so ROI will increase. This looks good for the manager of the division, but in the long term, you would agree it's bad for the company. This is called suboptimal behavior. A decision which in the short term is good for the manager, but in the long term is bad for the company, is called suboptimal behavior. Let's look at another way in which ROI can be manipulated. Okay, let's go back to the formula. ROI is equal to profit or earnings before interest and tax. It's the same thing. Or you could call it profit before interest and tax over average assets. ROI will be increased if you can find a way to reduce the denominator of this ratio, which is average assets. How can you reduce the denominator? Let's think about it. To deflate assets, one way is to operate with old assets. Old assets are depreciated. Look at the formula in front of you. We did this before. Book value equals the cost minus accumulated depreciation. The average assets, which is the denominator of the ROI formula, is valued using book value. So the older the equipment, the higher the accumulated depreciation, which means the lower the book value. So the lower the book value, the lower the denominator of the ratio, which means ROI increases. So ROI goes up. So managers are tempted to operate with old equipment and not to buy new equipment. In the short term, this is good for the manager, but in the long term, it's bad for the company. This is another example of suboptimal behavior. So, to check if managers are manipulating ROI, the ROI ratio is used in conjunction with two other ratios. The ratios are operating margin percentage, which goes as OMP. The formula for this ratio is profit over sales. OMP tells you a piece of information, a vital piece of information. It tells you how well is the company controlling its costs. Over time, if OMP goes up, it means the company is doing a good job controlling costs. If OMP goes down, vice versa, the company is not doing a good job controlling costs. Another ratio which is used is asset turnover. Here's the formula. asset turnover equals sales over average assets. Asset turnover also tells you something. It basically tells you how well or effectively is the company using its assets. How well or how effectively is the company using its assets. So, OMP tells you how well is the company controlling its costs. Asset turnover tells you how well or how effectively is the company using its assets. ROI gives you a feel for overall performance. Do you see a relationship between ROI, OMP, and asset turnover? So, have you figured it out? Let me put the formulas in front of you. Okay. The relationship is ROI equals OMP times asset turnover. This is called the DuPont formula. So when you read the book and they talk about the DuPont formula, it's in front of you. ROI equals OMP times asset turnover. Why is it called DuPont formula? Guess what? It was derived in the DuPont company in the early 1920s. Okay. We looked at a ratio called ROI. ROI is used by about 52% of companies in the US. There's another ratio to measure performance which is almost equally popular and used by 48% of companies in the US. It's called residual income. Okay, so let me recap. In the US, companies use two broad performance measures. One is called ROI. The other is a measure called residual income. The purpose of residual income is to try to overcome the problems of ROI, which I talked about. Here is the formula for residual income. Residual income is actual income minus a target income, target or budgeted income. The higher the actual relative to the budget or target, the higher the residual income, which means managers will be rewarded. How do you determine target income? Target income equals a desired rate of return times the average assets. The opportunity cost of capital is also called the desired rate of return. Now, let's work another problem. Here's the problem. We take a company which has two divisions, clothing division and jewelry division. The sales of both divisions are in front of you. The profit of both divisions is also in front of you. And I've given you the assets on January 1 of a hypothetical year, which is $360,000 for clothing and $870,000 for jewelry. And I've given you the assets for December 31st of the same year. So you have beginning assets for a hypothetical year. You have assets on Jan 1 and you have the assets at the last day of the year, which is December 31. The firm's minimum desired rate of return for investment center evaluation is 20%. Now here are the questions. Calculate the following for each investment center: OMP, asset turnover, ROI, and residual income. Part B. Which segment appears to be performing better on the basis of 1. ROI, 2. Residual income? Explain. I want you to take a few minutes, stop this recording, try the problem, figure out the ratios, and when you're done, restart. Are you done? Here's the solution. For clothing, the operating margin percentage is 18%, and for jewelry, it's 21%. What does the 18% and the 21% mean? It means that for clothing, for every dollar of sale, the division gets to keep 18 cents. For jewelry, it means for every dollar of sale, the division gets to keep 21 cents. The higher the OMP, the better the division at controlling costs. So here, jewelry is better at controlling costs. Look at the asset turnover. Remember, you have to use average assets. This is the assets for each division you have at the beginning of the year, plus what they have at the end of the year, and divide by 2 gives you the average. So the average assets for clothing is 400,000, and for jewelry is 944,444. So when you calculate it, the asset turnover is 2.4 for clothing division and 1.8 for the jewelry division. What does this mean? For the clothing division, asset turnover of 2.4 means every dollar of asset generated $2.40 worth of sales. For jewelry, it means every dollar of asset generated $1.80 worth of sales. Generally, the more effectively you use assets, the higher the asset turnover. So clothing is using assets more effectively, but jewelry is controlling costs better. So who's doing the better job overall? For that, we have to calculate the ROI. And the ROI is 43.2% for clothing and 37.8% for jewelry. So overall, we see that clothing is doing better when we take controlling costs and effective use of assets into consideration. When we take both into consideration, overall clothing is doing better. Now, let's figure out the residual income again. Here is the formula. Clothing and jewelry. Let's do clothing first. Residual income is actual income minus target. When I say income, I mean profit. 172,800 minus target. We decided the rate is 20% of average assets of 400,000. So the target was 80,000. The actual was 172,800. So the residual income is 92,800. Jewelry. The residual income is 168,111. So if we use residual income, we think jewelry is doing much better than clothing. Here's the problem. If we use ROI, we think the clothing division is doing better. If we use residual income, we think the jewelry division is doing better. So one method gives you one answer, another method gives you another answer. How do we resolve it? Before that, let's first talk about the problems of residual income. This is the problem. Jewelry division appears to be more profitable. Do you buy that? If you do, let me take you a step back and let me talk about the problems of residual income. One, it's more contentious because there are always disputes with the unions, between managers and the union. Unions would want a lower desired rate of return, and managers would want a higher desired rate of return. Why? Unions would want a lower desired rate of return, so the target income is low, so they can achieve it easily. Managers would want a higher desired rate of return, so the target income or profit is higher, so it becomes more challenging to the workforce, which of course they don't like. So it's always contentious. Residual income always favors the larger department or division. That's another problem with residual income. So, in this case, jewelry is the larger division. If you check, it has more assets. So chances are it will have a higher residual income simply because of the fact it's bigger. That's one of the disadvantages of residual income. Residual income could be a function of size and not efficiency. So what's the solution? How do you know which department is doing better? There's a homework problem which you'll have to do, which deals exactly with this issue. Okay, here's one thing you can do. Which is the larger department? Jewelry. So you ask, what's the extra or additional income relative to clothing? It's the profit of jewelry minus profit of the clothing division gives you 184,200. Ask the question, what's the extra or excess assets of jewelry? It's the average assets of jewelry less the average assets of the clothing department, which gives you 544,444. So, how efficiently has the jewelry department used the extra assets? If you compute the ROI on the excess assets, it comes to 33.8%. It's still less than the ROI of clothing, which was 43%. So your final conclusion is clothing division is performing better overall. This is a very important question when you use the residual income technique. How do you determine the desired rate of return in the residual income technique? In reality, the desired rate of return used by companies is what's called their cost of capital. You may have seen cost of capital in your finance courses. If you haven't, we're going to do a problem in a minute. Okay. Does this make sense? Now, let's do our last problem. Bob Shaftharder starts a construction company that's called Bob's Builders. The company obtains financing as follows. 100,000 loan, they gave you the interest rate. 200,000 in bonds, they gave you the interest rate. And 200,000 they issued common stock. And the dividend rate is 16%. And using the total funding of 500,000, they had three potential projects. Project A, which is remodeling, and I've given you information about how much assets it would require and the net income or profit it would generate. It's in front of you. Project B involves roof replacement, and the information about how much assets it would require and the net income or profit it would generate is in front of you. Project C is home extension, and again, you got the information in front of you. Okay. Which of the projects would you recommend they accept and why? If you use the ROI criteria. Then part 2, compute the residual income for the three projects. Which projects would you choose? Why or why not? And does your answer to part 1 change? I really would like you to try this problem. Stop this recording, try the problem to the best of your ability, and then come back and restart when you're done. Are you done? Okay, here we go. For project A, you get 11% ROI, B 13%, C 15%. If you use ROI, which would you accept? If ROI is greater than the cost of capital, you accept the project. If ROI is less than the cost of capital, you reject the project. Okay, that brings us to the question, how do we calculate cost of capital? Have a look at the table in front of you. The loan, if you get 100,000, the interest rate is 9%. So the cost is 9% of 100,000, which is 9,000. I'm sorry, I just realized it's shown as 90. It should be 9,000, not 90,000. The interest, let me repeat that. The cost, 9% of 100,000 is 9,000. There's a typo, and I do apologize. For the bonds, 200,000, 8% is 16,000. For the common stock, you issue 200,000. The interest rate, which is the cost of the common stock, which is the dividends you pay, is around 16%, so it's 32,000. So for the total financing of 500,000, the cost is 9,000, not 90, typo, I apologize. 9,000 plus 16 plus 32, which is 57,000. So the cost of capital is 57,000 for financing of $500,000. So the cost is 57,000 for a total financing of $500,000. So the cost of capital is 11.4%. Therefore, you should only accept projects B and project C, since only those projects generate returns higher than the cost of capital. Let's figure out the residual income. It's the actual income or profit, those words are used synonymously, minus the target. So here it's 16,500 for project A minus, if you use the cost of capital as your desired rate of return, 11.4% times the assets which was used, which is 150,000. So the residual income in project A is 600, negative. Don't accept. For project B, it's 13,000 minus 11.4% of 100,000, which is 1,600. Looks good. For project C, the residual income is 7,200. So you should accept only B and C and not A. To summarize, now you know how to compute ROI and how to compute residual income and evaluate the performance of divisions. Thank you. This is the end of the lesson.